How Amazon's book prices closed half of America's bookstores. Picture this. The year is 1995, and Barnes & Noble is riding high as America's book-selling titan. With over 900 superstores sprawling across suburban shopping centers, they've already earned the nickname the Walmart of books by systematically crushing thousands of independent bookstores through sheer scale and buying power. Their formula was devastatingly simple. Open massive 25,000 square foot stores stocked with 200,000 titles, negotiate volume discounts that small shops could never match, and watch local competitors wither away. Barnes & Noble had grown from 179 stores in 1991 to become a $3 billion empire by 1997, leaving a trail of shuttered mom-and-pop bookshops in their wake. But that same year, a small online startup called Amazon was quietly shipping its millionth book order, and the predator was about to become prey. What happened next would trigger the most dramatic collapse in American retail history, transforming a thriving industry of over 17,000 bookstores into a graveyard where fewer than 6,000 would survive. This is the story of how Amazon didn't just disrupt the book business, they obliterated it, turning Barnes & Noble from destroyer to victim in less than 2 decades. The stage was set for this industry apocalypse in the early 1990s, when book retailing was still a fragmented landscape dominated by thousands of independent stores. Barnes & Noble, founded in 1886 as a small Manhattan bookstore, had transformed itself into a corporate juggernaut under CEO Leonard Riggio, who understood that books were fundamentally a commodity business disguised as a cultural pursuit. Riggio's strategy was ruthlessly effective. Identify markets served by multiple small bookstores. Open a superstore nearby with the widest possible selection at deeply discounted prices, then wait for the competition to starve. By offering bestsellers at 30% off cover price and maintaining coffee bars and reading areas that turned shopping into entertainment, Barnes & Noble created the destination bookstore concept that drew customers away from smaller shops. The numbers tell the story of their systematic destruction of independent retail. Between 1991 and 1997, the number of independent bookstores in America fell from over 4,000 to fewer than 3,000, while Barnes & Noble's revenue exploded from $520 million to $3.05 billion. They had perfected the art of using scale to achieve lower wholesale prices, better real estate locations, and marketing budgets that dwarfed anything their competitors could muster. Local bookstores that had served communities for decades found themselves unable to match Barnes & Noble's prices or selection, and began closing at a rate of nearly 200 per year throughout the mid-1990s. Barnes & Noble's dominance seemed unshakable as they entered the late 1990s. But they were about to encounter an enemy that would use their own playbook against them with devastating effectiveness. Amazon, launched in 1995 by Jeff Bezos from a garage in Bellevue, Washington, started with a simple premise. Books were the perfect product to sell online because they were standardized, didn't require physical inspection before purchase, and could be easily cataloged in digital format. While Barnes & Noble was celebrating having 200,000 titles in their largest stores, Amazon launched with access to over 1 million titles through their wholesale relationships, limited only by warehouse space rather than retail floor space. More crucially, Amazon's cost structure was fundamentally different. They paid no rent for prime retail locations, employed fewer staff per transaction, and could reach customers anywhere with internet access rather than relying on geographic proximity. Bezos had studied Barnes & Noble's rise carefully and realized that their superstore model, while devastating to independence, was actually vulnerable to an even more scalable approach. Amazon's first-year revenue of $15.7 million was tiny compared to Barnes & Noble's billions, but they were growing at 900% annually, while traditional bookstores were expanding at 15% or less. The price war that would ultimately destroy half of America's bookstores began in earnest around 1997, when Amazon went public and gained access to capital that allowed them to sell books at unsustainable losses in order to build market share. Amazon's strategy was brilliantly simple. identify the best-selling titles that drove traffic to bookstores, and sell them at prices so low that physical retailers couldn't compete without destroying their own profitability. While Barnes & Noble was constrained by the economics of physical retail, rent, utilities, staff, and inventory costs that couldn't be eliminated, Amazon could optimize their entire operation around logistics and customer acquisition. They offered bestsellers at 40% to 50% off cover price, compared to Barnes & Noble's typical 30% discount, and backed this up with customer reviews, personalized recommendations, and one-click purchasing that made buying books addictively convenient. Barnes & Noble's response was to launch their own website in 1997, but they faced an impossible challenge: protecting their profitable physical stores while competing with Amazon's predatory online pricing. Amazon's revenue grew from $148 million in 1997 to $2.76 billion by 2000, while their losses mounted to over $1.4 billion as they deliberately sacrificed profits for market share. Traditional bookstores couldn't match this strategy because they needed immediate profitability to pay their fixed costs, creating a classic disruption scenario where the incumbent's business model became their greatest weakness. As the 2000s progressed, Amazon's assault on book pricing created a cascading effect that devastated bookstores of every size, but the damage wasn't immediately apparent because it happened gradually, then suddenly. Independent bookstores, already weakened by Barnes & Noble's superstore expansion, found themselves caught between two impossible forces: chain stores that undercut their prices through volume purchasing, and an online retailer that sold bestsellers below wholesale cost. Between 2000 and 2007, over 1,000 independent bookstores closed permanently, representing nearly one-third of all remaining independents in America. But Amazon's real breakthrough came with the introduction of Amazon Prime in 2005, which transformed occasional book buyers into loyal customers who received free shipping on all orders over $25, effectively subsidizing book purchases through membership fees. By 2007, Amazon had captured 12% of all book sales in America, while still losing money on most transactions, a strategy that would have bankrupted any traditional retailer, but was sustainable thanks to investor patience and cash flow from other product categories. Barnes & Noble watched their same-store sales decline year after year as customers increasingly used their physical locations for browsing, then purchased books online for lower prices, a phenomenon that became known as showrooming. The economics were devastating. Barnes & Noble paid rent and staff costs for customers to examine books. Then Amazon captured the actual sale without any of those expenses. The introduction of the Kindle e-reader in 2007 represented Amazon's masterstroke in their war against traditional bookstores, creating a closed ecosystem where they controlled both the reading device and the content, while simultaneously undermining the physical book market that sustained their competitors. Amazon priced the Kindle at $309, selling it at a loss, then sold ebooks for $9.99 regardless of the hardcover price, often losing $5 to $10 per best-selling title to establish digital books as a mass-market category. This strategy was economic warfare disguised as innovation. By making digital books significantly cheaper than physical books, Amazon could capture customers permanently within their ecosystem, while destroying the inventory-based business model of physical bookstores. Barnes & Noble's desperate response was to launch their own e-reader, the Nook, in 2009, but they were already 5 years behind Amazon's platform development and lacked the financial resources to sustain massive losses on hardware and content. Between 2007 and 2012, ebook sales grew from 1% of the market to 23%, with Amazon controlling approximately 65% of digital book sales and using their dominance to negotiate increasingly aggressive terms with publishers. Physical bookstores couldn't participate meaningfully in the ebook revolution because they had no way to sell digital products profitably, effectively ceding the fastest-growing segment of their market to their primary competitor. The period from 2008 to 2015 marked the acceleration phase of bookstore closures, as the combination of economic recession, e-book adoption, and Amazon's continued price aggression created a perfect storm that eliminated thousands of bookstores permanently. Borders, once the second largest bookstore chain in America with over 650 locations, filed for bankruptcy in 2011 after losing over $186 million in 2010 alone, their business model completely undermined by online competition and digital book sales. The Borders' collapse eliminated 10,000 jobs and removed approximately 35 million square feet of retail space dedicated to book sales from American shopping centers, representing nearly 20% of all bookstore capacity in the country. Barnes & Noble's situation grew increasingly desperate as their annual revenue peaked at $7.1 billion in 2007. Then began a steady decline that would see them lose over $2 billion in annual sales by 2015. Amazon's book revenue, meanwhile, reached an estimated $5.8 billion by 2013, making them the largest book retailer in America, despite selling most titles at minimal or negative margins. The statistics paint a picture of systematic industry destruction. Between 2005 and 2015, the United States lost approximately 2,200 bookstores, including 500 independent stores and the entire Borders chain. Small towns and suburban communities that had supported multiple bookstores for decades found themselves with no physical book retailers at all, as the economics of competing with Amazon's pricing made local book sales unsustainable. Barnes & Noble's near-death experience reached its climax between 2015 and 2018, when the company closed over 150 stores, saw their stock price fall from a 2006 high of $45 to under $4, and became a takeover target as investors lost confidence in their ability to compete with Amazon's dominance. The company's struggles illustrate how Amazon's strategy worked. By 2017, Amazon controlled an estimated 50% of all book sales in America, including 75% of ebook sales and 42% of physical book sales, giving them unprecedented leverage over publishers, customers, and competitors. Barnes & Noble's comparable store sales had declined for 12 consecutive years by 2018, as customers increasingly treated their locations as showrooms for books they would later purchase online for lower prices. The death spiral seemed inevitable. Fewer customers meant less revenue per store, which forced store closures, which reduced the company's buying power, which made them less competitive on pricing, which drove away more customers. Amazon's introduction of same-day delivery in major cities eliminated the last advantage of physical bookstores: immediate gratification, while their algorithm-driven recommendation system proved more effective at driving book discovery than traditional staff recommendations or shelf displays. The human cost was enormous. Tens of thousands of booksellers lost their jobs. Communities lost gathering spaces that had fostered literacy and cultural engagement. And the diversity of voices in book recommendation and curation was replaced by algorithmic systems optimized for sales rather than literary value. The final phase of this industry transformation occurred between 2018 and 2020, when Barnes & Noble was acquired by Elliott Management for $638 million, a fraction of their peak market value, while Amazon's book business generated an estimated $16 billion in annual revenue across all formats and channels. The buyout represented a stunning reversal of fortune. The company that had once destroyed thousands of independent bookstores was itself saved from bankruptcy only through acquisition by a private equity firm specializing in distressed assets. Under new leadership, Barnes & Noble began implementing Amazon-like strategies, including aggressive cost-cutting, store closures in underperforming markets, and increased focus on non-book merchandise that offered higher profit margins than books. The broader industry landscape that emerged from this two-decade transformation was almost unrecognizable from the diverse ecosystem of the 1990s. Amazon controlled roughly half of all book sales. Barnes & Noble operated fewer than 630 stores compared to their peak of over 900, and independent bookstores had stabilized at around 1,900 locations, representing less than half their number from 1995. The COVID-19 pandemic in 2020 accelerated these trends as lockdowns drove even more book sales online and forced additional bookstore closures due to reduced foot traffic and government restrictions. By 2020, the United States had fewer than 6,000 bookstores of all types, compared to over 17,000 in 1995, representing a 65% decline in physical book retail locations over 25 years. The ultimate irony of this industry killshot is that Amazon succeeded by perfecting the same strategy Barnes & Noble had used against independent bookstores, leveraging superior scale and capital access to offer unsustainable pricing until competitors collapsed, then inheriting their market share. Amazon's patient capital approach, backed by investors willing to accept losses for over a decade in exchange for market dominance, proved devastatingly effective against competitors who needed quarterly profitability to survive. The transformation of American bookselling represents one of the most complete industry disruptions in modern business history, eliminating not just companies, but an entire category of local business that had existed for over a century. Today's book market is characterized by extreme concentration. Amazon's dominance in ebooks exceeds 80% market share. Their physical book sales represent nearly half of all print sales, and their recommendation algorithms influence reading choices for hundreds of millions of customers worldwide. Barnes & Noble's survival as a much smaller, weakened company serves as a reminder that even successful disruptors can become victims when faced with competitors operating under different economic rules. The broader implications extend far beyond bookselling. Amazon's strategy of using books as a loss leader to build customer relationships and gather data has become the template for platform-based disruption across industries, from electronics to groceries to cloud computing. The death of half of America's bookstores wasn't just a business story. It was the preview of a new form of competition where patient capital, data advantages, and ecosystem lock-in effects could systematically destroy traditional retail categories regardless of their cultural importance or community value.